Bitcoin has slipped below the key $63,000 mark in recent trading sessions, a move that has captured the attention of traders and analysts alike who are now cautioning that the recent upward price movements in Bitcoin may be encountering distribution rather than robust accumulation by new buyers. This shift comes as Bitcoin finds itself trading around the $62,300 to $62,600 range after having touched higher levels near $63,700 earlier in the week, only to face selling pressure that has pushed it back down, reflecting a broader pattern of rallies meeting resistance at these elevated levels. Welcome to CryptoHub, your dedicated source for professional and data-driven cryptocurrency market updates, where we break down complex developments into clear insights that help viewers understand the forces shaping digital asset prices. In this edition, we will examine the precise mechanics behind Bitcoin slipping below $63,000, review the analyst commentary warning that rallies are being sold rather than bought, assess the latest institutional activity through spot exchange-traded funds, evaluate how major altcoins such as Ethereum are faring amid the same conditions, and outline the key levels and metrics that market participants should monitor closely in the sessions ahead so that the analysis remains grounded in observable data rather than speculation. The immediate price action shows Bitcoin opening the session with modest gains that quickly faded as sellers stepped in around the $63,000 area, pushing the asset lower in a manner consistent with the distribution thesis now being discussed by observers. Over the past 24 hours, the price has fluctuated within a relatively tight band, yet the inability to sustain momentum above 63,000 has become the dominant narrative, with trading volume on the downside appearing more pronounced than on the upside attempts, which is a classic characteristic of distribution phases, where supply from existing holders overwhelms incremental demand. Historically, such patterns have appeared during periods when the market transitions from impulsive advances to more measured consolidation, and while it does not automatically signal the end of a larger uptrend, it does indicate that participants who accumulated at lower levels are using strength to reduce exposure or rebalance portfolios. This behavior aligns with on-chain observations where exchange inflows have ticked higher during the recent rally attempts, suggesting profit realization rather than new capital deployment. And it is this combination of price rejection and flow data that lends weight to the cautionary stance articulated by several market analysts in recent commentary. Analysts have specifically highlighted that the rallies observed over the last several days lack the conviction typically associated with sustainable advances, because they appear to be driven more by short covering and opportunistic selling from longer-term holders than by aggressive buying from new entrants seeking exposure at these prices. In market structure terms, this distinction matters because healthy bullish moves usually coincide with rising open interest and positive funding rates that reflect leveraged longs adding to positions, whereas the current setup shows funding rates compressing or turning slightly negative, which can precede either a deeper correction or a sharp short squeeze, depending on how price reacts at key support zones. The phrase rallies being sold not bought therefore serves as shorthand for a market where upward probes are met with immediate offers that absorb the buying interest and force prices back down, a dynamic visible not only in Bitcoin but echoed across the broader cryptocurrency complex, where total market capitalization has contracted by approximately 3% in recent hours amid widespread deleveraging. This environment creates a self-reinforcing loop in which declining prices trigger additional liquidations that in turn pressure spot markets further, yet it also sets up potential relief rallies if enough short positions become overcrowded and vulnerable to rapid covering. Turning to institutional channels, the latest exchange-traded fund data reveals that after a record 13 consecutive days of outflows amounting to $4.4 billion from United States spot Bitcoin products, some modest inflows have begun to reappear, signaling that certain large allocators view current valuations as attractive entry points, or at least as areas where further downside may be limited. However, these returning flows have not yet translated into decisive upward price momentum, which underscores the point that institutional demand, while present, remains measured and selective, rather than the broad-based buying that would be required to push Bitcoin decisively through the $63,000 ceiling. The contrast between the end of the outflow streak and the continued price consolidation illustrates how even positive developments in traditional finance channels can be insufficient to override prevailing on-chain and derivatives dynamics, when overall risk appetite is subdued. Market participants tracking these flows should note that sustained weekly inflows above several $100 million would represent a more constructive signal, whereas sporadic or low-volume re-entries may simply reflect tactical positioning ahead of upcoming macroeconomic data releases, rather than a fundamental shift in sentiment. Ethereum, meanwhile, has displayed relative resilience, trading in a narrow range around $1,650 to $1,700, even as Bitcoin tested lower levels, yet it too has not escaped the broader risk-off tone, with several Layer 2 tokens and decentralized finance protocols experiencing amplified percentage declines during the same period. This divergence highlights how capital rotation within the ecosystem can occur during consolidation phases, with some investors rotating from larger cap assets into higher beta altcoins in search of outsized moves, or conversely reducing exposure across the board when macro liquidity concerns rise. On-chain metrics for Ethereum show relatively stable active address counts and transaction volumes, which suggests that network utility remains intact despite price pressure, but derivatives positioning mirrors Bitcoin, with funding rates indicating a cautious stance among leveraged traders. Should Bitcoin stabilize or reclaim $63,000, Ethereum would likely benefit from correlated upside, while a further slide in Bitcoin towards $60,000 could expose Ethereum to tests of its own critical supports near $1,500, where previous demand has emerged. The derivatives landscape provides additional color, with recent liquidations surpassing $1 billion across major platforms, as leverage positions on both sides were flushed out during the volatility, underscoring the high degree of leverage still present in the market even after earlier deleveraging events. When funding rates drop, as they have in recent sessions, it often reflects an increase in short positioning, which can create asymmetric upside potential through a squeeze if spot price begins to grind higher and forces those shorts to cover rapidly. At the same time, persistently negative funding combined with declining open interest on rallies reinforces the distribution narrative, because it shows that new long capital is not aggressively entering to absorb supply. Traders utilizing these metrics for timing should therefore watch for divergences between price and open interest, as well as shifts in the cumulative volume delta on major exchanges, which can reveal whether institutional or large trader flow is supporting or opposing the prevailing direction. Macroeconomic crosscurrents also play a role in the current environment, with equity market strength in certain sectors reportedly drawing liquidity away from risk assets, including cryptocurrencies, while any lingering geopolitical uncertainties or inflation data surprises can amplify moves in either direction. Although specific catalysts have been limited in the immediate term, the absence of fresh positive regulatory or adoption headlines has left the market more sensitive to technical levels and flow dynamics than to fundamental narratives. In such periods, historical precedent suggests that consolidation can persist until either a clear breakout above resistance or a breakdown below support occurs, with volume serving as the confirming factor. Bitcoin has spent considerable time in similar ranges during prior cycles, where distribution phases eventually resolved either through renewed accumulation at lower prices or through a capitulation event that reset sentiment and allowed for the next leg higher. Distinguishing which path is unfolding requires patience and attention to the metrics already discussed, rather than reactive positioning based on short-term noise. For viewers seeking to contextualize the current levels, it is useful to recall that $63,000 has functioned as both a psychological barrier and a technical pivot in recent weeks, with multiple tests from above and below shaping trader expectations. A sustained close below this level on increasing volume would likely target the $61,000 area, next followed by potential probes towards $60,000, where prior demand clusters and options-related barriers could provide temporary support. Conversely, any move back above $63,000 that holds for several sessions with expanding volume and improving funding rates would challenge the distribution view and open a path toward retesting higher zones seen earlier in the month. These scenarios are not predictions, but rather frameworks derived from observable price structure and participant behavior that allow for adaptive planning rather than directional bias. Professional market analysis emphasizes probability and risk management over certainty, and in the present setup, the balance of evidence leans toward continued caution until clearer signs of accumulation or decisive momentum emerge. Risk management considerations remain paramount in this environment where volatility can spike quickly around key levels and where leveraged products can magnify both gains and losses. Position sizing that accounts for the distance to the next major support or resistance combined with predefined exit criteria helps mitigate the impact of adverse moves, while avoiding the temptation to add to losing positions during distribution phases when rallies repeatedly fail. Diversification across uncorrelated assets or strategies, and maintaining liquidity for opportunistic entries during deeper pullbacks are practices that experienced participants employ to navigate such periods without compromising long-term objectives. It is equally important to recognize that cryptocurrency markets operate continuously and that news flow or unexpected order imbalances can alter the technical picture, rapidly making ongoing monitoring of the metrics highlighted earlier essential for any active approach. As the session progresses and additional data on ETF flows, order book depth, and derivatives positioning becomes available, the picture may evolve, yet the core observation that Bitcoin has slipped below $63,000 amid analyst warnings about the character of recent rallies provides a factual anchor for interpreting subsequent developments. Whether this marks the beginning of a more extended corrective phase or merely another pause within a larger constructive structure will depend on how buyers and sellers interact at the boundaries now in focus. CryptoHub remains committed to tracking these developments with the same rigor and objectivity, bringing forward only those insights supported by verifiable trading activity and established analytical frameworks. We appreciate the trust placed in us by our audience and encourage continued engagement through comments and questions that help refine future coverage of these fast-evolving markets. That concludes our detailed examination of Bitcoin slipping below the $63,000 threshold and the associated analyst commentary regarding distribution dynamics for this update from CryptoHub. We thank you for joining us and remind viewers that all market analysis carries inherent uncertainty and that independent research together with prudent risk controls should always guide any trading or investment decisions. Stay tuned to CryptoHub for the next professional market briefing and take care in these dynamic conditions until we meet again.